Happy Friday, traders. This is Fawad Razak, market analyst with City Index. Today is the 5th of December. Let's get into it. So it's been a bit of a mixed week for economic data from the US. And today we had the core PCE price index, which came in bang in line with expectations at 0.2% month over month. The consumer sentiment index from the University of Michigan beat expectations, if only slightly, at 53.3. But the key data release was earlier this week, the ADP payrolls, which came in negative 32,000, which caused the US dollar to tumble. And that kind of cemented expectations that the Federal Reserve is going to cut interest rates in the week ahead. Indeed, the market is now fully expecting a rate cut of 25 basis points come Wednesday. And the Federal Reserve is not the only central bank meeting next week, actually. We've got the RBA, the Bank of Canada, and we also have the Swiss National Bank all meeting as well before the focus turns to the Bank of Japan meeting in the following week, when we also have the delayed non-farm payrolls report and consumer price index from the US released as well. So there's a bit of economic data and central bank meetings to look forward to in the next couple of weeks, which should make the markets a little bit more exciting heading towards the year end. Looking at the charts now, and the dollar remains under pressure against most major currencies, especially against commodity dollars, given the fact that it's risk on, and we've had some economic data that have been stronger than expected, for example, from Canada today, where the employment data came in once again higher than expected, and that kind of cemented expectations that there will be no more rate cuts from the Bank of Canada. In fact, the next move from the Bank of Canada could well be a rate hike next year or maybe in 2027. But we'll cross that bridge when we get there. But for the time being, the pressure remains on the dollar, and the dollar index is looking quite shaky here after breaking its bullish trend line that had been in place since September. And it's now moved below the 200-day moving average as well as the 21-day exponential moving average. So clearly the path of least resistance is to the downside heading into the week ahead. Among the individual currency pairs, the dollar yen is going to be in focus in a couple of weeks' time when we have the Bank of Japan meeting. But ahead of it, we've seen the yen strengthen against the US dollar because of growing expectations that the Bank of Japan will deliver a rate hike at the end of this month. So that could be something significant in terms of the direction of the Japanese yen is concerned. If they come across more hawkish than expected, that's certainly a possibility. But if it's just a case of a one hike and a hold after that, it remains to be seen how much further strength we'll see in the Japanese yen. But it has now bounced off the 155 level, which is a key level of support, which has been tested in the last couple of days. And so far, we haven't posted a daily close below it. But if that changes, if we close below that, then things could become a little bit more interesting for this currency pair, which could see rates drop to 153 below this low, and then head down to low 150s ahead of the Bank of Japan meeting in a couple of weeks' time. For more market updates and insights, head over to cityindex.com. I'll see you in the next video. Take care.